But let's move on and just tell you about the markets in pre-opening have settled marginally lower, 0.3% lower. The biggest loser on the index on expected lines is TCS because the earnings this time around were a miss as far as the dollar revenue growth is concerned. And on all parameters except volume growth, TCS has actually done worse than Infosys this time around. So pull up the Infi stock. It's also down, but not as bad as what TCS is showcasing. So let's talk about that with our next guest. Mayuresh Joshi of Angel Broking joins us now. Mayuresh, what's your view on TCS? Do you think the scope for the upside could now be limited? One, because of its performance this time, and two, because it still continues to trade at premium valuations compared to its peers. So a little bit of that gap could narrow further.
Morning, Sonia. I think on the results front, it did disappoint both on the sales and the profitability front. The EBIT margins more or less in line with expectations. However, I think if you look at the client additions and the mining that they've done, I think it has been a substantial increase in the order book, which is 30% higher than its best book ever. If you look at their utilization rate at 86%, ex-trainees 82.3%, including trainees, attrition rate at 16.2. I think with the high base that they were coming through, I think a little bit of a disappointment was expected this time around. I think the management commentary also was suggesting that FY16 might have some headwinds like the Infosys commentary. So again, I think it's how you view the stock. I think if you're looking at the next couple of quarters, yes, generally the IT sector would largely underperform. But when you're looking about the next 4 to 6 quarters, and again, Q3, Sonia, would have a lot of furloughs, and that will mean less working days, and that will again have an impact on how the top line will pan out for a lot of these companies.
Okay.
But again, a 4 to 6 quarter view, I think TCS, in our opinion, should start delivering from FY17 onwards.
Okay, Mayuresh, morning. Thanks for joining us. Very importantly, I want to ask you about HDFC Bank. I was expecting that even in the pre-opening, the HDFC Bank stock could get a bit of a heart attack. It's only 0.7 down. In fact, Bank of Baroda is down 1.14%. The Bank of Baroda arrest was always expected for the past 1 week, ever since the news broke of those illegal or those unusual cash transfers. But the HDFC Bank employee arrest came as a bit of a shock. Would you still go ahead and buy the stock, primarily because it could fall because of this news?
Morning, Lata. Yes, possibly it will fall because of this news. But again, I think if you look at the structural story for the bank, I think it's been extremely strong. So I think if you just exclude these one-offs, and I assume that these are one-offs with the banking industry as a whole, clearly I think the asset quality has remained extremely healthy for HDFC Bank. The advances have grown very strongly. The management commentary has been very, very robust as well. So I think the CASA ratio is around 40%. The NIM band that the management is talking about between 4.1 to 4.4% looks extremely healthy. I think the non-interest income portfolio of the bank has grown brilliantly, with fee income growing at 21.8% year-on-year in the quarter gone by. And clearly, I think even if you look at the other aspects that one normally looks at banking stocks, the PCR is extremely steady at 71.9%. The restructured advances remain at 0.1% of gross advances. And though the earnings trajectory at 20% is much lesser, I think our take is that the bank is extremely poised well, both on asset quality, capital adequacy, which apparently stands at 12.8 on CAR 1. So clearly, I think all the attributes that a strong bank needs is there. The branch network is strong, which gives it the leverage for retail loans to grow at a faster pace. So again, at a price to book at 3.2, 3.3 times, even though it trades at a premium to the other private sector banks, I think the premium justification says. So any correction, I think it becomes a very good opportunity for long-term investors to get into the stock.
All right. Amit, you have a buy on Tata Chemicals this morning?
Yeah, I think there is something happening in the fertilizer space of late. We saw that how UPL started moving up, and then Tata Chemicals also, which was beaten down primarily because initially there was a good news that the stake sale, they are selling the fertilizers business, but because nothing concrete started from there, we saw heavy long liquidation in the stock because it had moved up before that, and then it was followed by the short build-up, and almost 60-70% of additions we saw when it slipped actually from 470 to 370 levels. But 370, 380 actually has been the last 3 years breakout. From 2011 to 2014, if you see, that was a breakout level, and from there now we have started seeing the closure of positions, particularly the closure of short positions. Around 25% of short closure we have already seen in the stock. That is why I think if this consolidation continues in the market, you will see these kind of mid caps performing more, and in that case Tata Chemical possibly can move up to 440 levels also.
Well, actually, Amit, we are running out of time. Can you quickly run us through your buy on PFC and sell on Colgate?
See, PFC, something different is happening this time in the power space since the news on the discoms started coming into the market, and initially we saw a good surge. Later on they went sideways, and now again it seems they are again started to move up. So from 240, it is possible it can move up to 265, 270 levels. And particularly one thing is important: when it came down from 240 to 200, the major short addition came, and now it has almost reached towards the 240 levels. So I think 100% of build-up came in the short side, and only 18% has been there in the short closer so far. So I think there is enough headroom for the shorts to get close in this stock. Now when I come to Colgate, I think this is one of them which is totally different, where people were long and very high leverage positions are there in the Colgate before, which were kept on rolling over, but the exits were not there for the long guys, and that is why the liquidation is coming now. We saw 955 levels. It was trying to form a base for the last 4 or 5 months, and now it seems it is giving up below 955. Yesterday it closed around 920, 916. My sense is it is going down towards 850 levels now in the coming days. So anything upward towards 930, 935 can be sold in the stock.
All right, thanks a lot for that, Amit. We have to quickly rush to the TCS stock and ask Kavaljit Saluja, the Executive Director and Head of Research at Kotak Institutional Equities, on the stock. Down 2% in pre-opening trades. Kavaljit, at 2,500, is it a buy for you?
We have a ad rating on the stock, and we yesterday cut down our target price from 2,800 to 26.75, and cut down the multiple a little bit from 20 to 19 times. I'm maintaining ad, because the company's execution, continues to be strong, and they seem to be doing well in digital services. And on top of that, the management, and of course, did allude to the fact that the order booking and some of the key business metrics are, in robust health.
Okay, we have lots more questions on TCS for you, Kavaljit, but we are just about 40 seconds, half a minute to trade starting, so I don't think you'll be able to finish your reply. At the moment, the markets are starting with 1/3% lower in pre-opening rates, 0.36 down. As you can see, the Bank Nifty is taking it on the chin, and it's actually surprisingly not HDFC Bank which is dragging the markets down, or at least not doing it alone. It's 0.7 down, but ICICI Bank is down 1.4%. We'll have to wait and see if things change after the trades come on, and TCS is starting with a 2% downtick, but it's not as if the rest of the IT stocks are doing exceptionally well. In the green is, of course, BPCL, which is going to be advantaged by the crude price. Okay, as the bell goes, the losses are expanding just a wee bit, not a whole lot more. 0.4 is what I saw on the Sensex, and that's it on the Nifty as well. But the TCS stock is now 2.5 down. Not a major heart attack. It has been an underperformer for some time now, and probably therefore to that extent the bad news is discounted, but now the losses are at 2.2. So it started off at 2.49, now at 2.25, 2.3 thereabouts. That seems to be the kind of disappointment that the market is expressing. Yeah.
I just want to point out, DCB Bank is down 20% in morning trade. We should just pull up that stock for you. It saw a big crack yesterday as well, post its numbers, and it's been a second consecutive quarter of weakness in DCB Bank. We got more negative internals after yesterday's, profit drop of 10%. The margins, the net interest margins for DCB Bank have also fallen to 3.79%. And this stock used to be an institutional favorite until last quarter, when it saw the first quarter of disappointment, and now a second consecutive quarter.
There's been there's a tax increase.
Yes.
It's not a huge provision increase, and the NPLs have risen only by 3 basis points. So we were not prepared for this kind of sell-off. But obviously, the markets are probably discounting the fact that it got a lot of positive vibes, and therefore the markets are creaming off from the DCB stock with some alacrity. Thanks for pointing that out. That's a very important stock to keep in your mind, and we will toss it to our experts as well. But that's the market for you. value. It started off with a 0.3% downtick or a 0.4% downtick, but now the losses are actually reducing. And while the Bank Nifty is not helping much, ICICI Bank is still in pain with a 1.6% downtick. There is decent amount of gains coming in stock like Sun Pharma, ONGC, IndusInd Bank, Lupin, Kotak Mahindra Bank, PNB. The rest of the banking stocks not doing too badly. Must bring up HDFC Bank as well. It's not struggling much. It is seen, it's quite clearly been taken as an individual case of fraud, and the bank is not being visited with too much by way of punishment. Quickly, Sonia.
Well, in the mid-cap space, Mercator is a big mover on the upside. It's up 10.5% now. So is the case with some of the other shipping companies like SCI, GE Shipping. All these companies, Shreyas Shipping, are all up about 3 to 6% on the back of the news that we just focused on. So that's a pocket to look at. Bharat Forge is the big stock on the downside, as CLSA has, after being bullish on the stock for very long, has finally downgraded the stock to a sell from a buy, and they've slashed the target price to 745 versus 1465 earlier. So that's a big downgrade coming in on Bharat Forge. Apart from that, you have, from that same shipping pocket, a couple of others like ABG Shipyard also that are looking good. So there's a sentiment bump up that you're seeing. Whether these companies eventually get higher orders or not, only time will tell, but there's a sentiment bump up for sure. From the frontliners, it's TCS that continues to be the big stock in focus. It's down about 2.5%. Kamaljeet, I wanted to come to you on the trade between TCS and Infosys now, because this quarter we've seen that barring the volume growth, Infosys has done better than TCS in all parameters. Do you expect a shift of money out of TCS and into Infi now?
I think the growth rates for Infosys is accelerating. The company seems to be doing the right things. The convergence in growth versus TCS has happened will happen in this year itself. And I would not be surprised if some of the money moves away from TCS, which has been disappointing now for 4 to 5 quarters. Some of the money moves from TCS to Infosys.
Okay. Well, coming back to you in a second, Kamaljeet. Sonia, a word on Bharat Forge. That's actually one of the big volume-led losers, and CLSA has clearly made it a sell from a buy, and that's hurting the stock quickly.
Yes, there's a big target price cut as well. So they've slashed the target price by almost 50% to 745. The concerns that CLSA has put out are well documented. One is that there's a continuous decline in new truck orders in the US, something that we have been covering for a while. And also industrial exports has been reducing consistently. So that is something that has spooked the street as well.
Okay. Well, to come back to you, Kamaljeet, what about the management commentary? How much weightage would you give? Menaka tried her level best, but Chandra would not be drawn into anything company specific. He was more strong about, positive about the industry. Though, of course, they have been extremely positive on their order booking. When do you see, or do you see TCS giving better numbers for FY17?
I think first and foremost, it's important to delve into, what could have been the reasons for underperformance of TCS or, marginal disappointment quarter after quarter. I think, there are a few factors which may be hurting TCS. One is the fact that the company has a higher exposure to run the business services, which is facing a lot of pricing pressure, and there's a fair bit of cannibalization. The second could be portfolio, issues which the management has called out from time to time in the past. And at the end of the day, the growth is also a function of, what kind of exposure do you have to various clients. And I think a combination of these things would have, pulled down the growth rates of TCS. Moving into FY 2017, the way we see growth for TCS is that we are expecting roughly a similar growth in constant currency as compared to 2016, which is 30-odd%. Our belief is that, in the next year for TCS, run the business services will grow slower, but, our digital will continue to be a growth driver for the company as such.
Okay, well, another pocket that's looking good once again this morning is the aviation space. So Jet Airways, after a big run-up of more than 10% yesterday, is up another 2.5% today. And we should look at the chart of SpiceJet as well, that has been running away for the last couple of days. So once again, there's a green tick that you're seeing on these names. But Mayuresh, I wanted to come to you on DCB. Why do you think the stock is down 20% today?
Largely, Sonia, I think the numbers did disappoint. I think great expectations were probably laid out in terms of how the performance might pan out. So I think on the asset quality and again on the provisioning front, so it's been a marginal uptick on the tax provisioning part. Clearly, I think the provisioning aspect is something that the street is not too pleased about. So again, as I mentioned earlier as well, I think the other private sector ones like the Yes Bank and Axis is something that we'll continue to like. I think the asset quality there is at least much more stable. And again, the capital adequacy remains strong, aided by the fact, again, that the earnings growth looks far better compared to the other banks. So again, I think the larger private sector banks is something that we would lay our long-term bets on.
Okay, Kawaljit, looking at the TCS performance, would you want to rethink your valuations for Infosys simply because people will be willing to bet more and some money would shift? Have you changed your price forecast for Infosys? As well, are you now beginning to have some doubts over the other IT majors?
So is the question that does TCS performance raise doubts about the sector growth in general?
Yeah, and up your preference for Infosys a little more.
Infosys has been a top pick, so I mean, I don't know, so there is no change in preference on the stock. But I think, as far as your question on TCS's performance, raising doubts on the growth of the sector is concerned, I mean, the way I look at it is that at the beginning of the year, the entire street was penciling in a significantly higher growth for TCS and HCL Tech, and a lower growth for Infosys. And of course, at the beginning of the year, the Cognizant estimates were also fairly conservative. What has happened is that the sector growth has remained, I think, unchanged. The sector will still grow at 12 to 13%, but there is a share shift. So in a way, your estimates on HCL Tech and TCS has gone down, but estimates on revenue growth estimates on Infosys and Cognizant, has gone up. So it's more, what I would say, a shift in share across different companies, which is influenced by portfolio and a whole host of other factors, rather than the change in the industry growth in itself.
All right, Kawaljit, thanks for giving us your views on the IT sector. TCS is still one of the big losers of the day, but DCB Bank, cannot take your eyes off that stock, 20% lower now. We must also make a point that the move in DCB Bank in the last 1 year has been irrational on the upside. So from 40 to about 130, it's been a very swift move. So now there's some, letting off of steam on the stock. And of course, there were a lot of internals that disappointed the street. The profit drop, margins have fallen this time. So Ekta is here to give us more on that. Ekta.
Well, if you look at the P&L, there wasn't really any surprise in the P&L, but there is a Kotak downgrade which has come, and I'll just read it out. They've downgraded the stock all the way to sell from buy, and they've titled the report as Advancing Costs and Pains. What they have said is that DCB is looking to double its branches to 300 employees by 50 to 60% in the next 12 to 14 months in what appears to be, and I quote, a very dangerous, unexpected and disappointing shift in their strategy of steady improvement in cost ratios, focusing on risk and improving return ratios. The return ratios appear weak in the short term, ROEs of less than 10%, which could lead to repeating mistakes that the bank committed in the past decade. They've downgraded the stock, in fact, to sell from buy with a revised target price of 100 from 150 rupees. So I think that is the key point of concern, because I was looking at the other parameters. There was no surprise that came out from the P&L. The slippages were largely in line with what they did last quarter. It is this branch expansion which they have mentioned in terms of FY16 and FY17, which has really not gone down well with the street. And Kotak, like they have mentioned, is that they're possibly fearing that maybe the expansion and the strategy undertaken by the bank could be reminiscent of what they had done in the past. Remember, DCB is a turnaround story.
Absolutely. And it is actually the higher taxes, so it's not really an inherently very weak set of numbers. But this is important, and I would think that DCB is also responding to the fact that there's going to be huge competition from payment banks and small banks, and that perhaps is the reason for their response.
Yes,
Yeah.
and just a couple of things about the change in strategy. It's basically what they have mentioned is that it is a downgrade to sell as the investment thesis appears to be broken at this stage. So quite a important report coming in from Kotak.
Thanks a lot for that, Ekta. Sudarshan, just one word from you on DCB itself. Does this fall make it attractive, or you don't catch this falling knife?
No, it doesn't make it attractive. It was never a favorite bank for me, so I wouldn't buy this fall at all.
Okay, what about the biggest loser on the index today, Sudarshan, TCS? What's the next level to watch below that 2500 mark?
See, rather than levels, the theme is that IT is probably starting a correction. So, as I said in the morning, the same theme applies. I would be a seller in TCS and Infosys. Its lower levels are coming. It's difficult to identify where it will stop and where support will come. That's not relevant.
Okay. I also wanted to ask you about Bharat Forge, Sudarshan. That stock has seen a nearly 6% knock. Is that a buy in distress, or is that sell short?
Oh, it's a sell short.
Okay.
Some of these companies, that's a pity. The rally that we saw in Bharat Forge was so tepid, it was nothing. And it's resumed its downtrend. So it's probably looking at much lower levels again. There is a bigger theme playing around which you have to explain someday. Why are all these mid-cap stocks coming down?
Okay, well, I really wish I knew, but we will have market masters joining us, and I guess they'll be in a better position to explain that. So, Sudarshan, thank you very much for joining us and staying with us through the opening trades. Mayuresh, let us finish on a positive note here, this conversation. You have a buy on IOC.
Oh, yes, Lata. And again, I think the structural side for most OMCs have meaningfully played out over the last 2 quarters. Falling crude prices, under recoveries going down substantially, working capital requirements going down have played decently on their balance sheets. What goes ahead with a lot of these OMCs would be how structurally they would play out their throughput ratios. And clearly, I think IOC, with the expansion that one's seen in the Paradeep refinery, a 12 MMTPA consolidated refinery coming through, that increases its refining capacity by 23% to 80.7 MMTPA. And clearly, I think the condensate complexity itself at 12.2 will give it a higher weightage in terms of how the GRMs will pan out. So in the immediate short term, I think the GRMs might remain subdued when you do a simple comparison check, which how the Singapore GRMs are panning out. Our take is that most of the positives in terms of the EBITDA margin expansion would start meaningfully playing out in FY17. So EBITDA margins of 2.3% that IOC had posted in FY15, I think you should see a meaningful increase. You're looking at a 300 bips increase happening over the next couple of years. And clearly at a price to book of 1 times looks attractive. So any declines onto these stocks, and specifically IOC, I think it becomes a very good opportunity. We've got a target of 455. Assuming a 6 times EBITDA on a consolidated EBITDA on FY17 at 24,700 odd crores, and if you exclude the minority interest and if you apply 0.8 times book value on the investments, I think you're getting a fair value of 455.
All right, Mayuresh, you have a good day. Thanks for giving us those long-term stock ideas. Well, for the market, it's opened with a slightly negative view, but the underlying theme is that if there is any whiff of bad news with any stock, that stock is getting sold off big time.